All right, welcome to the deep dive. Today we are really digging into Primoris Services Corporation, ticker Prime, big infrastructure player.
Yeah, and their Q3 2025 earnings call was, well, it was something.
It really was. If you just glanced at the headlines, record revenue, record earnings. They raised guidance for the whole year. I mean, textbook beat and raise.
Absolutely. That textbook, operationally, a triumph. But here's the kicker, the paradox we need to unpack for you today.
Market reaction.
Exactly. Despite those stellar numbers, the stock just tanked. Sold off right away, kept falling. It was pretty brutal.
So when you see that disconnect, great execution, horrible stock reaction, it screams that the market is ignoring the now and punishing perceived future risks.
That's precisely it. So our job today is to figure out what that future risk is, what the market's so worried about.
Okay, but first, let's give credit where it's due. Those Q3 numbers were genuinely impressive. Top-line revenue, $2,178.4 million.
Which smashed consensus by about 20%. That's huge.
Yeah.
And it's up 32.1% compared to last year. Just massive growth.
And the earnings were maybe even stronger. Adjusted EPS came in at $1.88.
Yeah, and Wall Street was looking for, what, $1.32? So that's a beat of like 42%. Incredible operating leverage there.
Mm-hmm. Adjusted EBITDA kept pace too, up 32% year over year, landing at $168.7 million. These aren't, rounding errors. This is peak performance.
Peak execution, absolutely. And they didn't stop there. They immediately turned around and raised the forecast for the full year 2025.
Right. New adjusted EPS target is $5.35 to $5.55. And adjusted EBITDA, $510 to $530 million. So they're clearly expecting to finish the year strong.
They are. Based on the work they have lined up, yes.
Yeah.
But this is where that market disconnect really bites.
Because the stock drop says investors just don't care about the rest of 2025. They're looking straight past it.
Seems like it. They're worried about 2026 visibility.
Yeah.
When you have a quarter this good and the stock still falls, it almost always circles back to concerns about sustaining momentum. And that concern, it shows up in the backlog.
Okay, let's get into this backlog anxiety then. This feels like the crux of it. They ended Q3 with about $11.1 billion in total backlog, which still sounds enormous.
It is enormous. But crucially, it was down sequentially from Q2 by about $430 million.
And that's what spooked the market, even with $11 billion still there.
Yes, because of where the drop happened.
Yeah.
It was all concentrated in the fixed backlog. The projects with firm contracts, predictable revenue.
Ah, okay. So the market sees that fixed backlog dip and thinks demand is drying up.
Right. But management, they had a different story, much more nuanced. It boiled down to two things. One, an incredibly fast revenue burn rate, and two, some significant timing delays in signing new contracts, specifically in the energy segment.
Let's clarify that burn rate thing first. What does that mean in this context?
Okay, so think of it like this. You sign a big construction deal, value goes into backlog. As you do the work, send invoices, that value gets burned off the backlog and turns into revenue.
So a high burn rate means they're just working really, really fast.
Exactly. Way faster than planned, especially in the renewables business. They had a record quarter there, partly because they accelerated projects, got materials delivered early, just blew through the work.
And the numbers on that acceleration were pretty wild. Didn't they say they pulled forward something like $400 million in revenue just into Q3?
Over $400 million in Q3 alone, yeah. And over $900 million pulled forward year to date. That's why they had to bump up the full-year renewables revenue forecast to almost $3 billion.
So it's not a lack of demand, it's they're too efficient, completing 2026's work now.
Pretty much. They finished jobs in 2025 that everyone, including investors, had penciled in for 2026 revenue. That burns through the fixed backlog super fast.
Okay, that explains the burn. What about the other piece, the timing delays on new contracts?
Right. So management said some large contract signings got pushed out, delayed by maybe 3 to 6 months.
Why? What caused the delay?
Customer uncertainty, specifically around supply chains, tariffs, and importantly, all the legislative volatility.
We're talking about the Inflation Reduction Act, the IRA here, the rules around that.
That's the big one, yeah. Uncertainty about how exactly the IRA provisions will work, plus worries about global tariffs. It just made some customers hit pause before signing massive long-term EPC contracts.
So the projects aren't dead, just waiting, kick the can down the road a bit.
Exactly. They're sitting in the pending pile for a few extra months. But that creates a potential gap, a timing hole for 2026 revenue, and that's what scared investors off.
Okay, I understand the mechanics of it, but but here's where I push back a bit. If they were executing this much faster than expected, shouldn't they have seen these delays coming sooner or communicated the pull forward impact more clearly beforehand?
That's a fair challenge, a really fair challenge. There's always some visibility risk, right? Especially with projects so closely tied to government policy like the IRA.
So why should the market trust their high confidence about Q4 and 2026 bookings now?
Well, management's argument is their confidence comes from the sheer size of the funnel, the number of bids out there. They believe the underlying demand hasn't changed. They feel the market is punishing them for external regulatory timing stuff, not for internal execution, which, they clearly nailed this quarter.
It's a tough sell when the stock reacts like that, though.
It is. But while all this drama was unfolding in energy, you had the utility segment just acting like this rock-solid anchor.
Yeah, that stability was impressive. Double-digit revenue growth, right? Up almost 11% year over year.
And across the board, too, gas, power delivery, communications, all firing.
And the key indicator there is the MSA backlog, the master service agreements, those long-term recurring deals.
Exactly. That MSA backlog actually grew sequentially, added almost $500 million, hitting an all-time high here, $6.6 billion. That's the foundation, driven by huge trends like grid hardening, power investment, stuff that isn't going away.
What were the specific drivers they called out within utilities?
Well, gas operations is apparently heading for a record year, lots of replacement work. Power delivery had its best quarter in ages. Clients are really moving on grid upgrades. But the interesting one they highlighted was communications.
Because it's not just about basic broadband anymore. It's linking up with data centers.
Precisely. Think about the AI boom, cloud computing, insane demand for data center capacity. And those centers, they need enormous high-speed networks built out, big EPC contracts.
And Primoris is chasing that.
Actively. They mentioned targeting over $100 million in bids just for those large data center-related network builds soon. That tells you where they see a big chunk of future infrastructure growth powering and connecting the digital world.
Okay, let's swing back to energy then, the problem child this quarter. Management sounded really bullish about refilling that fixed backlog quickly. Like Q4 would be huge for new bookings.
Extremely bullish. They basically promised the book-to-build ratio for energy in Q4 would be well north of 1, maybe even 1.2 or 1.3.
Which means signings would outpace the revenue they recognize.
Right, and they backed it up, saying they'd already booked over $600 million after Q3 ended, with another $600 million basically waiting for ink in the next few weeks.
So from their perspective, the Q3 backlog dip was just a blip, a timing issue.
That's the narrative. Just a clerical delay, essentially. And it's not just about the delayed solar projects moving forward either. They highlighted two other areas in energy turning from headwinds into tailwinds.
Which were?
Pipeline and industrial services.
Okay, tell me about pipeline. That had been weak, right?
It had, but they see a major upcycle starting in 2026, driven by bigger, higher value pipeline projects. They're talking maybe $100 million to $200 million in extra revenue growth next year just from that segment. That's a significant shift.
And industrial services, how does that tie in?
It connects right back to what we just discussed, data center power needs.
So building the power plants needed for the data centers?
Exactly. Natural gas generation is apparently at a decade high because data centers need reliable power, 2047. And the grid often can't supply it all directly. That work flows into their industrial services unit.
And that's good margin business.
Very good margins, running near the top of their 10-12% target range. And they expect that business to grow by another $100 million to $150 million next year.
Okay, so if you add up the potential growth in pipeline and industrial services, that starts to fill the gap left by the renewables revenue being pulled forward.
That's the critical point the market seems to be missing. There's a shift happening in the business mix, driven by these other powerful trends.
And financially, they're in a fantastic position to handle this shift and fund the growth. Balance sheet looks incredibly strong.
Rock solid. Yeah, gross margins dipped a bit year over year, mostly because they didn't have some high-margin storm work they had last year and fewer big project closeouts. But efficiency, incredible.
SG&A down to 4.5% of revenue, that's great leverage.
It really is. And the debt situation is almost non-existent. Net debt to EBITDA is just 0.1x. They're swimming in cash flow, and liquidity ended Q3 with $746 million total liquidity.
Basically zero net debt and $750 million available.
Pretty much, which lets them boost organic investment. They raise their CapEx forecast, but more importantly, it gives them huge firepower for M&A, disciplined, smart acquisitions.
Which loops us back to that core conflict, doesn't it? Market fretting about 2026 timing, management sitting on a pile of cash, executing well, and looking at a pipeline of over $1 billion in pending deals, plus M&A potential.
That's the tension right there. Execution versus forward-looking anxiety, amplified by that backlog dip.
Okay. So, as we always do here on the deep dives, let's transition to our segment. This is not financial advice, where we cook up a slightly wild, but maybe plausible trade based on everything we've just heard.
And this one has to revolve around that balance sheet, right?
Yeah.
$746 million in liquidity, virtually no debt. Management explicitly talked about looking at M&A.
Specifically to add scale or new services. And didn't they mention data centers again, like the work inside the data center?
They did, the inside-the-box stuff. Specialized high-margin infrastructure builds within the facility itself. They already connect the power to the data center. This would be capturing the next, arguably more profitable step.
Okay, so they have the cash, they have the stated intent, and there's a clear strategic fit with a massive growth area. The market's currently ignoring this because it's fixated on the 2026 renewables timing.
Correct. So the trade idea plays on that potential catalyst. You use that market myopia. Given the cash pile and the strategic focus, the idea is maybe looking at long-dated call options, or perhaps a call spread targeted maybe 3 to 6 months out.
What's the bet?
The bet is simple. Primoris announces a significant acquisition, a decent-sized bolt-on, using a good chunk of that $746 million within that time frame, specifically targeting that data center infrastructure space.
And why does that specific M&A move potentially fix the market's 2026 problem?
Because acquiring a business in that high-growth, high-margin data center vertical immediately plugs a new revenue stream into their forecasts. It diversifies away from the renewables timing concern and shows they're deploying that idle capital strategically. The stock pop on that kind of news could be very substantial.
Interesting. It hinges on management actually pulling the trigger on M&A, but the setup is definitely there.
It is. So let's try and wrap this all up. Primoris delivered a monster Q3 operationally. Beat estimates, raised guidance, textbook stuff.
But the stock got hammered because the market focused laser-like on a sequential dip in the fixed backlog, fearing it signaled a 2026 slowdown.
A fear driven by accelerated execution, pulling renewables revenue forward, and some delays in new contract signings tied to, regulatory uncertainty around the IRA and tariffs. Temporary timing issues, according to management.
Yeah, and management sounds convinced Q4 bookings will roar back, especially in energy, with that book-to-build expected well over 1, if that happens.
Then the current stock price looks like a serious mispricing, right? Punishing strong execution because of temporary external timing factors.
Which brings us to our final provocative thought for you. Is the market so caught up in the renewables timing that it's completely underestimating the combined power of the other growth engines kicking in for 2026? We're talking the pipeline upcycle and that huge wave of natural gas generation needed for data centers.
Are those potentially big enough and high margin enough to more than offset the revenue pulled forward from renewables? That's the multi-billion-dollar question.
Definitely something to chew on. As always, we encourage you to check out the source materials yourself. Let us know what you think.
Yeah, we'd love to hear your take.
Until next time, this has been The Deep Dive.